If you're in trucking and not tracking your profit per mile, you could be losing money every single week without even realizing it. Most owner-operators think gross revenue means success, but revenue is not profit. And the truth is, a truck can stay busy every day and still lose money. The carriers making real money in this industry understand one thing: profit per mile matters more than load price. Most truckers focus on the wrong numbers. They look at total load amount, weekly gross revenue, or how many loads they hauled this month. But none of those numbers guarantee profitability. A $2,000 load might look amazing on paper, but if fuel costs are high, deadhead miles are long, and delays waste time, that load may barely make profit. This is why so many owner-operators feel busy, but their bank account never grows. Because trucking is not about how much money comes in. It's about how much money stays after expenses. The biggest financial leaks in trucking usually happen silently. Deadhead miles destroy profitability. Every empty mile means fuel is burning without generating revenue. Then there's maintenance. Tires, oil changes, repairs, unexpected breakdowns. All of it reduces actual profit. Fuel prices also play a massive role. A slightly inefficient route can cost hundreds of extra dollars every week. And many drivers accept loads too quickly, without calculating their real cost per mile. That's where the losses start. A truck moving constantly does not automatically mean a profitable business. Without proper numbers, most carriers are simply guessing. Profit per mile is the number that tells you what you actually keep. It's calculated by subtracting expenses from revenue, then dividing that by total miles driven. Profit per mile equals revenue minus expenses miles driven / text. Profit per mile equals /frac text. Revenue / text. Expenses / text. Miles driven. Profit per mile equals miles driven revenue minus expenses. This single metric reveals whether your trucking operation is healthy or struggling. For example, if two loads both pay $2,000, but one requires far more deadhead miles and fuel, its actual profit may be dramatically lower. That's why smart carriers stop chasing high-paying loads blindly. Instead, they focus on efficient miles, strong lanes, and consistent profitability. The most profitable carriers operate differently. They reduce deadhead miles as much as possible. They study lanes carefully and avoid markets with weak rates. They negotiate with brokers instead of accepting the first offer. They monitor fuel usage constantly and choose routes strategically. Top carriers also understand minimum acceptable rates. They know when to reject cheap freight, because every bad load creates hidden costs, extra wear, wasted fuel, driver fatigue, and lost opportunities for better freight. Profitable trucking is not about staying busy every second. It's about running smarter miles. The best dispatchers and carriers focus on quality loads, not just quantity. If you want to improve profitability, start by tracking every mile your truck drives. Loaded miles, empty miles, all of them matter. Next, calculate your true cost per mile. Include fuel, maintenance, insurance, truck payments, and operational costs. Once you know your real number, you can stop accepting unprofitable freight. Focus on stronger lanes with consistent demand. Build relationships with brokers who pay fairly, and negotiate every single load. Even small rate improvements create massive yearly profit increases. The goal is simple: maximize profit, not just revenue. Most trucking businesses don't fail because they lack loads. They fail because they don't understand profitability. The carriers who survive long-term are the ones who master their numbers. So stop focusing only on gross revenue. Start tracking profit per mile, because that one metric can completely change your trucking business. If you want to optimize your dispatch strategy, increase profits, and stop losing money without realizing it, DM profit and start running smarter freight today.